Well, this is a very special interaction we are having on ET now. This is not about day-to-day markets, but this is more about how you should be approaching investing, especially in turbulent times. The theme of this interaction is making of a value investor. That's correct. This is the book I'm talking about, and it is by my dear friend Gautam Baid, practitioner of investing and internationally acclaimed author as well. And of course, friend of the new investor here in India. After a success, very big success as far as compounding the earlier book is concerned, this is the second book, and this is much more hands-on as far as the practice of investing is concerned. Gautam, thank you very much for joining us, and congratulations on your second book as well. This is more of a journal, right? And you have always been an advocate of journal entries by an investor so that one has a track record of the entire investing journey which an investor has actually covered. So before I go into the details of the book, talk to us about why do you advocate this practice that people should be taking notes of why they are buying a stock, what went wrong, or even they made a loss, the entire hypothesis one should be taking note of. Why do you advocate that?
Well, Ajay, there are multiple benefits of maintaining an investment journal. Firstly, I use it to learn a lot about myself and to correct my biases. Maintaining a journal has helped me improve greatly, both as an individual and as an investor. I've also maintained a personal archive of the media commentary and subsequent investor behavior during various episodes of Market Panic since 2014. And I find it highly beneficial to refer to this information whenever the markets undergo their periodic severe corrections, because human nature in the markets has not really changed much in many centuries. So maintaining a journal helps you maintain your equanimity and calm during periods of market turbulence. And most importantly, it also helps you avoid hindsight bias, because many a times we confuse outcome with the process. Many a times we may be right for all the wrong reasons. Investment journal helps prevent this bias and helps you get honest feedback on the outcome of your investing decisions. This is how you keep getting better over time.
Well, that's correct. Even Buffett, one of the market gurus which you follow and who have actually made a note also on your earlier book, also is a big advocate of maintaining a journal. Okay, let's dive straight into the book then. The origin of this book is also when the market was really bad, right? In turbulent times, how does making notes and entries, especially in bad times, how you can learn from, is something with the genesis of this book. So on June 5th, I see an entry from you in this book about small caps. And there is so much being talked about small caps even right now. The small cap, mid cap is very frothy. And a lot of young generation of investors have actually forgotten how small cap, mid caps are treated in a bear market, because a decent bear market hasn't come for several years. Small reluctant corrections here and there. So the memory of a good bear market is very small. Talk to us about what are your learnings about how the rules of small caps should be, and which you have learned painstakingly in a bear market.
Well, Ajay, that's a very good question. And the number of demat accounts in India have actually tripled from 3.5 crores to more than 10.5 crores since April 2020, when the last bear market actually ended. And very few people actually know what a true bear market actually looks and feels like. And a real bear market will actually will gradually wear you out mentally and emotionally. And it is only when the last bull surrenders and gives up then that the bear market actually comes to an end. So, some of the biggest learnings actually always take place from a bear market, and those lessons bear fruit for an entire lifetime. And I've shared many of them in this book, and I will share a few of them with your audience today. Number one, if you want to make it big as an investor in the stock market, you need to be mentally and emotionally detached from stock price fluctuations, because during periods of severe market stress, it becomes extremely difficult to endure such sharp drawdowns. That's the first point. The second point is India will grow at a healthy rate. Nifty earnings will compound at low double digits, but at any point of time, there will be a few mid cap and small cap names which will grow their earnings per share at a rate of 25 to 30% over the next 3 to 5 years. and they are bound to create wealth in the longer run. You just need to have the confidence and the conviction to back them. In the long run, what ultimately counts is earnings, earnings, and earnings. Number 4, sanity will eventually prevail after every bear market, like it always does. So it is always the darkest before the dawn. You need to keep the faith that this too shall pass, and you need to just hang in there and not sell your high quality stocks in panic. You need to have extreme levels of patience. And the fourth and biggest learning, and this is very important, believe in India and the power of its entrepreneurs and business system. If you look at all the legendary investors of Dalal Street, all of them have got one common attribute. They all had a relentless belief in the power of this country and its long-term future. So these are some of the very big learnings, which will help you stay the course during difficult times.
Sure. The other very specific example I want to understand from you, Gautam, is about within small cap and mid caps, the investing world is always very excited about special situation investing, be it a buyout, be it some kind of merger, demerger, unlocking of value. This usually, is something which the retail HNI is very excited about. What are the things one should be very careful about as far as special situation investing is concerned? And you have made some entries in October around it. What are your learnings, and if you could share by examples?
Well, I've been practicing various forms of special situation investing over the last 15 years in the market. But in my view, the base rates of success are the highest in 3 specific categories. Number 1, demerger of a micro cap or a small cap company from a large cap parent. It has got residual institutional shareholding, because this often leads to forced selling in the small cap demerged stock after listing, after demerger, and that is when you get a deep value buying opportunity. So that's the first instance. The second one is that of merger arbitrage. So I'll give you a live example from the current market. So Ujjivan Financial is basically merging with Ujjivan Small Finance Bank, and for every 1 share of Ujjivan Financial, you will get 11.6 shares of Ujjivan Small Finance Bank. So if you just look at the merger ratio right now, there is more than a 15% merger arbitrage discount on the table. And we have a very high probability of this merger getting through and getting NCLT approval, because we had a similar reverse merger which recently concluded between Equitas Holding and Equitas Small Finance Bank. So you basically want to maximize your base rates of success by looking at similar situations which have taken place in the most recent past. It's not a stock recommendation, and we hold Ujjivan Financial in our PMS and in our India fund. The third category of special situation, which has got a very high success rate, which I've talked about in my book, is promoter or management change. And here, the really big money in promoter and management change situations takes place not when the business being sold was previously being run efficiently. The really big money is made when the previous management, which was running the business, either badly or far below potential. And this is so in investing, it's all about delta. That wherever you find the maximum scope of change on the positive side, that is where the really big money is made, because valuation re-rating is a key ingredient for multi-bagger stocks.
Very interesting. In fact, there's a saying on the street that you should always keep a stock on your radar where either the story is changing or the storyteller is changing, as far as special situations are concerned. Okay, let's move on and talk about another style of investing which investors do follow, and that is timing entry and exit in commodity stocks. You have made very good reference of investing in commodity stocks. What are the rules which apply there? Because a lot of times here in India, people watch data coming out of China and US and try to place their bets as far as commodity stocks are concerned. And a lot of time they turn out to be commodity traps. What is your learning out of that?
Well, commodity investing in general is very counterintuitive, because here, the lower the P multiple, the more expensive the stock is in reality, because the earnings per share, the denominator for these stocks, is the maximum at the peak of the commodity cycle. So here you ideally want to buy into such stocks when a couple of leading players in the industry are going bust, supply is coming out of the system, supply is reducing in the system, and you want to basically capitalize on the capital cycle theory here. So basically, capital cycle theory simply means that as the competitive intensity in an industry reduces, the return on capital of the remaining players in the industry starts to improve. They exercise better discipline. And during the upcycle, that is when you make the maximum amount of money. So you want to ideally enter into such commodity and deep cyclical place when the industry is under severe stress. And again, you just need to check for two things primarily. Check the debt on the balance sheet to make sure that the company can survive another 1 or 2 years of an industry downturn, and check whether the company has got sufficient positive operating cash flow to service the debt. So once those elements are in place, and the industry supply situation is improving, that is when you enter, and that is how you get those big multi-bagger returns from commodity stocks.
Right, interesting. Gautam, we all who study investing know that over the really long term, it is not about how many sixes you hit, if I may use cricket terminology in investing. It is about how many runs, it's somehow how many wickets you have actually escaped. So you don't want to get out, even if you score low, over the long term actually gains compound. So my next question to you is about avoiding fatal mistakes. How did you avoid stocks like, how do you tell our viewers they can avoid stocks like DHFL, Manpasand beverages, these kind of fatal mistakes? How can one avoid them?
Well, in lending businesses, in particular like DHFL, in this particular industry, it's all about management. And it's about partnering with those managements that you can trust, because trust is a vital ingredient of valuations for a lending business, given that as an investor, you cannot really look at each and every loan that they give out. In an opaque business like lending, your primary bet is a trust in the management. So that's the first point about a lending business like DHFL. Now, if you talk about 1% beverages again here, so if a consumer company, which is supposed to be a very highly free cash flow generative business, keeps on raising capital and keeps on diluting equity or capex, then that's something which should make you sit up and take notice. But again, in the markets, because it's a probabilistic activity, even after our best efforts, we will go wrong a few, many times. So the way to handle such unknown future is to prudently diversify across industries and risk factors. So this is one of the biggest learnings which I got from the bear market, was that prudent diversification is the way to go to survive at an aggregate portfolio level over the long run, because this practice ensures against a catastrophic outcome for the portfolio as a whole, and it also opens the door for you to optionality. So focus on prudent diversification and a focus on quality of the business and quality of the management. This is the mantra for long-term success in the Indian stock markets. And in a country which is transitioning from a developing to a semi-developed stage, the pace of change and the pace of disruption will only pick up pace from here. And therefore, like I've written in this book as well, that the days of taking a 5 to 10 year view on a stock are long gone. In today's fast changing, highly disruptive environment, I believe 2 to 3 years is the maximum feasible period which you can start with for your initial view on a stock. And then at the end of the first 2-3 years, if the future business prospects continue to look good, then you can continue to hold on. And this is how long-term multi-baggers actually happen in reality for investors.
Gautam, you also made some entries regarding the relationship of political environment and markets. In fact, the first 9 years of this government, I mean, it is being termed as the Modi rally because of the reform getting triggered 2014 onwards. We are at that juncture once again. There are entries made, and you have made your observations. State elections. Chris Wood says if BJP loses election, in the general election, it could be a 25% fall. What are your learnings related to the relationship markets have with political changes or developments in the near term?
Well, here I would like to quote the former Prime Minister of Singapore, Lee Kuan Yew, who said, "If you know history, you think medium and long term. But if you do not know history, then you think short term." We have to go back into history to see what were the actual developments in the market post formation of a weak coalition government. So in May 2004, for example, when the BJP lost the general elections and we had a very weak coalition government coming to power, the Sensex immediately hit a 20% lower circuit, but within 6 months, it was back to all-time high. Similar thing with geopolitical tensions as well. In 1999, when we had the Kargil war, That time also markets sold off very sharply, but within 6 months we were again back to all-time highs. So in this book I've talked about this, that India is, the growth trajectory of India is too strong to be managed by a single group of politicians. India will grow despite its political parties, not because of its political parties. Political parties will come and go, but India will continue to march forward, and bottom-up stock picking will continue to work over the long run. Of course, having continuity of the existing political dispensation matters a lot to the market, and that is why markets which can promise you years of stable government policy, they deservedly get a valuation premium. Currently also the markets have basically factored in continuation of the current political dispensation from next year onwards as well. So obviously in the short run next year, if something goes wrong there, you will have a sharp knee-jerk reaction and a very big fall in the short run, but then it will be back to the usual markets as we know them. So these things are just basically speed blockers in the long-term India journey, but they will not stop you from creating big wealth in the long run, provided you invest in good quality businesses.
So talk about how investors are a very impatient lot, including you at some point in time. You speak about how sometimes the expectation the investors are to time the stock or the market in a way that they come in just at the cusp of growth spurt and completely avoid the slow period in a particular stock. How would you say that strategy actually plays out? Because that is being attempted every day. Is it easy to implement that strategy?
It's not easy at all, and timing the market is far more difficult than it actually looks in reality. So we always use this statement that time in the market is much more important than timing the market, and it is so true, because if we could perfectly time the entry exit even a few times in our careers, then we could simply enter the derivatives market and make a fortune. But we all know that in advance these things cannot be predicted. And in this book I've actually talked about this, that many of us investors, we are actually at times too demanding of entrepreneurs and businessmen. It takes a lot of grind and effort to actually build a company for the long run, but we investors just want to get in during the growth spurt of the business and then exit at the first signs of trouble. But we should actually be very grateful to these promoters and entrepreneurs for taking so much and enduring so much hardship and putting in so much blood, sweat and tears into actually building a solid business for the long run and letting us investors partake in the success of the enterprise. So we should we should learn to be a bit more patient and a bit more forgiving of mistakes by management. No one makes all these mistakes knowingly, but they are part of life in general. And I think as long as the mistakes are not fatal, and as long as any capital misallocation is not very big in magnitude, I think we can live with those smaller errors and give management some leeway.
Gautam, you also mentioned about your experience with MNC stocks in India. If I were to take the most recent example of Siemens, there are some transactions every now and then which come about by MNCs which appear not to be very good for minority shareholders. In fact, how has your experience of investing in MNC stocks in India been? Because traditionally they've commanded very high very high valuations, but the delivery on returns has not been that great.
Right. So I've talked about this in my book as well, that many MNCs get the so-called valuation premium for good corporate governance, but their corporate governance is highly overrated, because in many cases they set up all the lucrative part of their business is set up in a privately held entity, not in the listed entity. They also many times engage in slum sales of the promising businesses to their parent at a deep discount. That is not good corporate governance, and there are related party transactions galore in these MNC companies. So I think they should not get a valuation premium, corporate governance premium. They should get a corporate governance discount given the practices that they follow. And the growth rates in many cases are subpar, low double digits or single digits in many instances. So paying 70-80p multiples for single digit growth is bound to lead to disappointment in the long run. So these stocks then end up becoming value traps, and your money is stuck in those businesses for a long period of time, where you end up incurring big opportunity costs by not participating in the high growth small cap and mid cap businesses available in the market. So In good investing is all about taking opportunity costs into account, and these stocks can get your capital tied up for long periods of time.
Gautam, let's shift focus and also talk a little bit about the current investing environment and the landscape as you are observing. You're hailing from India, you understand the Indian system very well, the economic landscape and environment. Yet you have spent a lot of time in US and also based out. The rate trajectory in the US, yields, dollar index, all of that have been adverse to emerging market and India so far, but the case seems to be reversing. Would you agree that at least those concerns are now appear to be under control, or do those risks also still pose issues for India?
Well, the most recent Federal Reserve meeting made it very clear that the Federal Reserve is broadly done with its interest rate hiking cycle. And history teaches us that whenever the big global central banks start the interest rate easing cycle, that is when a big gush of money starts flowing into emerging markets like India. And a lot of the high quality large cap and high quality mid cap stocks do extremely well, because that is where the first port of call is for the FIs. First, they enter the high quality large cap stocks, then they enter the high quality mid cap stocks, and that is when you end up with valuation re-rating along with earnings growth, and you get very handsome returns. So I think the worst of the interest rate hiking cycle is behind us, and from here on next year, it looks very promising for emerging markets, in particular India, which provide you political stability, geopolitical neutrality, because India has taken a non-aligned stance against against Russia and in case of Israel as well. So basically that gives us a very big geopolitical advantage in the world as well. And many foreign investors are looking for a safe oasis like India in a world which is being marked by great political and geopolitical turbulence. So the next 12 months look very, very promising in that regard for the Indian market.
Gautam, just for example purposes, what to understand your own construct of the portfolio right now, with the disclaimer that these are just examples and not recommendations, what kind of stocks are making your largest positions right now as far as India is concerned, if we were to take top 2-3 names?
Sure. So again, like you mentioned, these are not stock recommendations, and we are holding these stocks in our PMS in India as well. So in investing, the really big money is made when there is a scope for large changes. So let's take the example of the latest addition to our PMS portfolio, multi-commodity exchange, MCX. So for a long time, this business was being bogged down by the technology transition from 63 Moon Technologies to TCS. Now that the transition to the new tech platform is complete and it's running very smoothly, and with the introduction of shorter duration contracts and options volume really picking up steam, the operating leverage will now start kicking in, and you can expect this business to post net profits of more than 500 crores in the next 1.5 years. That gives you a current 1 year forward P multiple of broadly 22 times. And generally in India, high quality exchanges trade at 40 to 50 times multiple. So you'll get the valuation re-rating over time along with earnings growth, and you should make good returns from this particular business. Another recent addition to our PMS portfolio was Prudent Corporate Advisory. So this is one of the leading mutual fund distributors in India, and we are betting on this business to play the mega trend for the next decade of financialization of savings. We have already seen in the last 4 years how the monthly SIP flows have doubled from less than 8,000 crores to 16,000 crores as recently as September. So over time, as investor participation in the Indian markets keep going up, and with the growing trend of awareness about the benefits of investing in mutual funds through the Mutual Fund Sahi Hai campaign, I think this monthly SIP number will just keep on going up over time. And this is a business which will directly benefit from that particular mega trend.
And the third, if you could share the third largest position or anything else which you are early researching right now?
Well, right now, I'm without naming the stock right away, I would just say that right now we are researching the power transformer space, because in the US and in Europe, right now there's a big power transformers shortage, and there are a few listed companies in this space which are having a very good time right now, and they're still available at very reasonable valuation. So we are yet to initiate positions in them, but this particular space looks very exciting for the next 2 to 3 years. Power transformers, and there are just a few pure play listed companies in this space in India.
Sure. No, in fact, the entire power space in India, right from legacy power producers, renewables, transformers, the lines, the transmission lines, wires and cables, the entire value chain is undergoing a massive transformation. So I'm not surprised if that is also coming on your radar. Great chatting, Gautam. Like always, thank you so much for your time, and congratulations on the new book once again. Thank you very much.
Thank you so much, Ajay. This was a pleasure. Thank you.